So it's a nice time we meet for a session of financial reporting. So this CPA Dinochoy. So today we are going to talk about published financial statements. So this is a compulsory topic in the financial reporting paper. It's a very compulsory topic in the financial reporting. So when we talk about published financial statements, as a student, what are you supposed to know? So as a student under this topic, you need to know how to prepare these statements. Which are these statements? So we have various statements which are meant for the publication purposes. So you need to know how to prepare an income statement. So that is one of the published financial statements. So an income statement. You need to know how to prepare statement of changes in equity. You need to know how to prepare statement of financial position. And again, you need to know how to prepare a statement of that is a cash flow statement. So statement of cash flow. So I can call it cash flow statement. So the published financial statements, I have mentioned the include income statement. We have a statement of changes in equity, statement of financial position, and we have a cash flow statement. So this is according to International Accounting Standards 1 and International Accounting Standards 7. So International Accounting Standards 7 is concerning cash flow. Then International Accounting Standards 1 is concerning how you prepare now the income statement, statement of changes in equity, and the statement of financial position. So just to start with the first statement, that is an income statement. So what does an income statement contain? A question to the class. What makes up an income statement?
It's expenditures and income.
Yes, it's all expenditures and income. So remember from your financial accounting, there's that format, for company accounts, for the preparation of an income statement. So when we come now to the published financial statement, so now concerning this income statement, concerning the income statement. So the incomes, which we call expenditure, the incomes, they are supposed to be classified under various functional heads. So which are these functional heads? So expenditures, which we call them expenses, they are supposed to be classified under cost of sales, under administrative costs or expense, under selling and distribution, and under finance cost. So the expenditures are supposed to be classified under functional heads. So in a statement, when you will be presenting your statement, that is now an income statement. The expenditures, those are now expenses. Like now, let's say you are paying your director, that is the salaries. Maybe you are incurring office related expenses. Remember that those expenditures, you are not supposed to show them individually in the statement. So what you are supposed to do, like now, office related expenses, they are supposed to be classified under administrative cost. They are supposed to be classified under administrative cost. The expenses which facilitates a distribution and the sales, so selling and distribution. Like now, let's say you are paying for advertising. Remember that companies like now pays for the adverts. So where are they going to classify expenditures of that kind when they are supposed to recognize them under the income statement? So expenditure like advertising, you are paying your sales agents. So those expenditures, they are supposed to be classified under distribution cost. So we call it selling and distribution. So you are supposed just to do a separate working, and just present one figure under the income statement as selling and distribution. Then other expenditures are supposed to be classified under finance cost. The interest related expense. This is concerning loans. So let's say if you were giving out or you are receiving some loans, remember that you have to pay interest on the loans. So the interest you pay out of the loans, they are supposed to be classified under finance cost. So you are not supposed to show in a question that you have interest on loan, you have interest on debenture. So all of them, they will be summed up together and presented as finance cost. That is under the income statement. Then other expenses are supposed to be classified under the cost of sales. So some of the expenses will be classified under the cost of sales. So right now the disposal, if the asset was disposed and you made a loss, so the loss on disposal, for example, of a certain asset, so that one can go to the cost of sales. And some of the specific expenses they can mention on how to classify. So what you need to understand is this first statement, which we call it an income statement. Sometimes they call it a statement of comprehensive income. When you are presenting your expenses, they are supposed to be presented under the functional heads. So some expenditures will go to the cost of sales, some will go to the administrative cost, some will go to the selling and distribution, and some will be classified under finance cost. And that is all. So another thing is all about knowing the format, whereby you start from sales, you raise cost of sales, you get the gross profit. After the gross profit, you add some incomes. After adding some incomes, you raise expenses. So the expenses is all about the selling and distribution and administrative cost. You get profit before interest and tax. You minus finance cost. You get profit before tax. You minus tax. You get profit after tax. You add the profit you retained from the previous year. You minus dividends. Then you add other comprehensive incomes. So that one I will show you on how to do it when I will be doing a question. And at the same time, I have prepared some short notes which you can go through to understand more about that. Then the next thing is concerning the statement of changes in equity. So what does a statement of changes in equity shows? What does a statement of changes in equity contain? Someone?
Ordinary shares, share premium,
Mm-hmm.
retained earnings.
Yes, those we call
Yes.
them in general equity components. See, that is good. We call them equity components. So which means that you have to check the changes in those equity items. So the movement of the equity component. So the changes anyway. So we can say that the statement of changes in equity. So this one shows the movement of equity or the changes of the equity element. Things like now ordinary share capital, as one of our students has said, share premium, revaluation reserve, retained earnings, and another reserve like general reserve. Then when we move now to another statement, which is now the statement of financial position. The statement of financial position. So they were calling it sometimes back balance sheet. The statement of financial position is the same as the balance sheet. I think you have ever heard of the word balance sheet. So what do you know? What do you need to know all about this statement of financial position when you are doing a published financial statement? When you are presenting now a statement of this kind under International Accounting Standards 1. So when you are presenting your non-current assets, the non-current assets, which we call them things like land and building, motor vehicle. We have things like furniture and fittings. So assets of those kinds, like now, the examples I've mentioned. So those assets, the tangible long-term assets, they are supposed to be classified under the property, plant, and equipment. So maybe you have ever come across a question whereby you have a property, plant, and equipment. So today you have known that property, plant, and equipment, the property, plant, and equipment contain long-term tangible assets. So examples are land and buildings, fixtures and fitting, we have plant and equipment. So those ones you sum up together so that you present one figure under that statement. You present just one figure under that statement, which we call property, plant and equipment. So it contains long-term, non-current. So the tangible, long-term. So the tangible ones. So that is the tangible long-term fixed assets. So the long-term is just the same word, fixed assets. So that is all about a statement of financial position. Because now the intangibles, things like goodwill, trademarks, and copyright. So those ones are supposed to be shown independently. So those statements of that kind, they are supposed to be presented independently in the statement. They are supposed to be presented independently in the statement. So right now, if there's goodwill, so that one you present it, goodwill, it is shown in the non-current asset. If there's trademarks, that one is okay. But for the tangible long-term assets, you classify them together as separate working. Then when you present it in the statement, you just come with one figure, which we call it property, plant, and equipment. Then finally, you might be told that after you have presented your statement, present your statement, you present your statement showing notes to the account. So who can be able to tell me which notes can I show? Which notes can I present in three statements which I have just explained? For example, now we have prepared an income statement, we have prepared a statement of changes in equity, we have prepared a statement of financial position. After that, you are told showing notes to the account.
The method of depreciation used.
Yes, the method of depreciation used. Another thing. So these accounting concepts can include the depreciation methods we use in the depreciation of the non-current assets. So like now we can use methods like straight line in the depreciation of the asset. And you know how the straight line is done. And with that one would be more illustrated when we do a question. We can use reducing balance method. We can use the sum of digit method. So it matters with the method you used. So you can talk about the method, and even going forward, you can tell them this was the percentage when I was using, maybe it was reducing. You can talk about the accounting concepts or about the accrual concept of accounting and cash basis. Maybe you use the accrual. Accrual is the best, and that one will track your incomes very well and some of the expenditures you incur. You can talk about accounting standards. Like now, specifically, we know that inventory are measured using international accounting standards too. So we measure inventory using the international accounting standards too, whereby we say that inventory is measured at the lower of cost and the net realizable value. So you check the cost and the net realizable value. So whichever, so between the two figures, whichever is lower, lower between the two. So that is between cost and the net realizable value. So you can talk about the accounting standards used. Like now you can talk about goodwill. If it was there, maybe like under published, you cannot find that there is calculation of those goodwill and so on. So those are some of the things you can talk about: depreciation, accounting concepts and the policies, the accounting standards used. So those are some of the notes you can give. So this one will assist these individuals who doesn't have the knowledge of accounting to understand your statements, because these statements you prepare, remember that you present as an accountant, you have to present them to the shareholders, the guys who have interest in the organization during the AGM, before even they are made public. So I think you have ever checked on the newspapers. Sometimes behind those newspapers, towards the end, you find that we have various audited statements which are published. So this is what I'm talking about. So how are they preparing those statements so that they can be audited and published to the public? And investors rely on these statements to make investment decisions. So I was saying that, again, according to International Accounting Standard 7, there's another statement which is among the published that we call it a cash flow statement. So under this cash flow statement, this one I will cover it later as a topic on its own. But it's among the published financial statements. But it's covered. On my case, I will cover that statement as a topic. Because even the setting way of KASNEB, sometimes they can test the three statements separately. That is the income statement, statement of changes in equity, and the statement of financial position. So that one can come in one question. Then the cash flow statement, again, can be tested as a separate question. That is why I always consider teaching the two separately. So for now, since I have now introduced you to the topic, I can share the notes on the screen. I can project the notes so that I show you what I've been talking about before we embark to our whiteboard, whereby I will be now computing, whereby I will be doing the calculations on how you are supposed to present those statements now according to the questions when they test in an exam scenario. But for you again to do those questions, you know that you have to use the information I've been sharing with you. You have to follow those rules from the income statement, statement of changes in equity, and the statement of financial position. So this is concerning some of the handwritten notes. These are my notes I scanned sometimes back, but they are okay for now. Remember that even if they change the syllabus again and again, financial reporting cannot change. There's no way you can change an international standard. Maybe now maybe they bring in another standard. Like now there was a standard they changed, but that one is changed internationally, not in Kenya only. Concerning recess, you know, recess is under which international accounting standards? So you can check on that. So recess was one of it which was changed a bit, but internationally. Then we have IFRS 9. You can check on that. So those are some of the standards which have been changing internationally. So the IFRS 9 and the one which is under IFRS 16. So IFRS 16, now it's IFRS 17. So you can check on what I'm talking about. So there's no way you can change a standard. Maybe what KASNEB can do, maybe they remove a topic here and they take it to advanced financial reporting. Like now in the coming syllabus, things like a topic of banking and insurance, which was under financial reporting, will be taken to the advanced financial reporting. So you are beneficial, you are benefiting a lot. So once I will do banking here and insurance, again you will be doing it in the advanced level. It will be in the advanced level. But it's just a very simple topic. So published financial statements. So I have said that published financial statements are financial statements meant for publication. So the investor will depend on these statements to know how the company is doing. So these are some of the statements I've mentioned about. Statement of comprehensive income, statement of changes in equity, statement of financial position. And we have the cash flow statement. So I have written in brackets that I will teach cash flow as an independent topic, and I've given an explanation why. Then we have notes to the account. I've tried to explain that. So statement of comprehensive income, I said the main thing we consider is what? The expenditure part of it, whereby you present your expenses on functional basis. So that is what they have said here. IS1 requires that published financial statements of comprehensive income should be prepared on functional basis. So functional basis is the basis of preparing financial statements of comprehensive income where expenses are recognized depending with their functional heads. So that is cost of sales, selling and distribution, and admin. There's one which is missing there, which we call it finance cost. So expenses are classified under that, under cost of sales, under selling and distribution, and under administrative and finance cost. So this is the format, I talked about it, whereby we start from revenue, we raise cost of sales, we get our gross profit, we add some incomes. Remember, incomes can be investment income. We have increase in fair value of financial assets. So never worry, for now, understand, because these notes I will share with you guys. So what you will be doing, maybe you can be making short notes when I will start doing a question. But for these notes, I will share with to your WhatsApp group, of which I think I already did. So we raise expenses. Expenses is all about the admin expenses and the selling and distribution, so that you get profit before interest and tax. So after that, we have finance cost. Remember that finance cost again is part of some of the functional ends where we classify expenses like interest on loans. We get the profit before tax. We raise tax. We get the profit after tax. We get the profit after tax. So after getting the profit after tax or profit for the year, and you are supposed to add the profit from the previous year. This is the retained profit brought down. So remember that we have started from this, the format, that is why I'm moving with speed so that we can do some questions. This is just a statement, So I was talking about after getting the profit after tax or profit for the year. Remember that we have to add the retained profit brought down, that is from the previous year. Then after that, we have to raise some dividends which were paid or proposed, so that we get the retained profit now for the year. Then we have to add some comprehensive incomes, like now revaluation, gain or loss, and this one is on long-term assets, the tangible ones. A good example is land and building. So if there's a revaluation on land and buildings, so that one we have to check if it's a gain or a loss. If it's a gain, it's we add, or if it's a loss, we subtract. Then increase in financial assets. So remember the financial assets, these are some of the financial instruments. Go and check IFRS 9. If you want to read more about financial assets, please note somewhere that read IFRS 9, financial instruments. Then actuarial gain or loss. This is now concerning the topic of employee benefits. So this one is concerning the employee benefits, the actuarial gain or loss, then foreign exchange reserve. So, but mostly according to your level, what you can find here under other comprehensive income is this revaluation gain. Most of the question I will do, what you will come across is this revaluation gain or loss of long-term tangible assets. So then we have a statement of changes in equity. I think I asked this one, what does it pertain? One of our students told us that it contains ordinary share capital, share premium, reserves, and retained earnings. So you list them the way I've listed in this format. Then the thing you start with is the balance brought down. So the balances you are given. So this is the first thing you do. The balances you are given as per the trial balance. The balances you are given as per the trial balance. Then the next thing you have to do is all about the issue of shares at premium. You add issue of shares at premium. What is a share premium? Someone? When you hear share premium, what is a share premium?
Sold.
So that is what I've talked about here. So the balance brought down. So you risk maybe if there was a share premium, ordinary share capital, revaluation reserve, retained earnings, general reserve. So you pick as per the trial balance. Then you consider now if there was some issue of shares at premium. Remember, it has to affect the ordinary share capital and it will affect your share premium. Then again, if there's a revaluation gain, remember that it goes to the revaluation reserve column. Then profit for the year, this is from the income statement you have prepared, the profit after tax. The profit for the year is the profit after tax from the income statement you have prepared. So for example, now in our format here, the profit for the year is this one. It will be this profit after tax here. This profit after tax. Then after that, you have to pay dividends. So remember that the profit for the year goes to the retained profit column. Profit for the year goes to this is the retained earnings column, or we call it retained profit column, and the total. Obviously, these figures, you have to take them to the total. I am assuming you know that. Then the next thing is all about dividends. Remember, dividends are paid out of the profit, so you reduce that. So the amount of dividends paid, you subtract it under the retained earnings column and the total. Then now you transfer some amount to the general reserve. So remember that organizations could like to put some reserves, some amount, that is, organizations could like to put some money aside to cater for uncertain future events. Like now, some organizations which were doing the same from the previous periods, when corona, this is, we call it COVID-19 came, remember some organizations went ahead to use money which were under their reserves. So this is what I was talking about, the transfer. So transfer to general reserve is just some amount which is taken. But for you to do that, examiner must tell you that there was something they transferred. So that amount which is transferred is subtracted from the retained earnings, from our profit, that is the retained earnings, and added to the general reserve column. So it's a certain amount we take from the retained earnings, we add it to the general reserve. So we put it aside. Maybe if there's anything which might arise in the future, we can be able to be a going concern organization so that we cannot struggle for long financially. So then you add your figures, you get the balance carried down. Then we move to the statement of financial position. So under this statement of financial position, remember there's this aspect of tangible non-current assets. So that is what I said, that you have to aggregate them together and you present them as property, plant, and equipment. So in the statement of financial position, items of non-current assets should be aggregated together as property, plant, and equipment. So the tangible non-current assets. Examples are like land and building, plant and equipment. We have things like furniture and fitting. So the tangible ones, of which I say we have others which are supposed to be shown independently. That is what our second sentence is talking about. So the foreign and current assets are not considered to be part of PPE and they should therefore be reflected individually in the statement of financial position. They should be reflected individually in the statement of financial position. Which are these assets which are shown independently? So the intangible assets, things like goodwills, patents, trademarks, and copyrights. Then number two, we have financial statements. So the available for sale financial statements, which is an uncurrent asset, and financial assets at fair value, which is a current asset. Mention somewhere that read IFRS 9. Go and research on IFRS 9 if you want to understand more, because this is a topic on its own. Before I come to that topic, just go and do your short research concerning IFRS 9 so that you can understand what am I talking about when I say financial assets. The note to the accounts, this one I already explained that these are explanations how you are preparing your financial statements. So you can talk about accounting standards used in the preparation of the statements, which I said right now, you can talk about inventory, which is obvious, measured using international accounting standards too, which says that inventory is mentioned at the lower of cost and the net realizable value. Then you can talk about accounting concepts and the policies used. So either the accounting concept or the accrual concept. So not the accounting, but the cash basis concept and the accrual concept. So the accounting concepts and the policies used. So you can talk about the cash basis and the accrual basis. We have other explanation. You can talk about the depreciation method you used. So some other standards which were applicable, and the many other explanations which you can be able to pick direct from the statement you have prepared. So up to that point, I can say that we are done with the introduction of the published financial statements concerning the income statement, statement of changes in equity, statement of financial position, and notes to the accounts. So what I will be doing next is now to present a question to you on how you are supposed now to do the question in an exam scenario. So we can go to a question of November 2015. We start from that point as we move to the November 2016. Then we move to December 2014, May 2015. Then I will come to finish with the question of 2021. Because I think there was some students who asked about that. So that one might be done as revision. But for now, I want to do a question of 2015 November. So let us now add to the whiteboard so that we can be able to tackle out that question if there is no another question or addition from the class. So let us look on the question of 2015 November. So they say that Dora Limited, a quoted company dealing in the household goods, has prepared the foreign trial balance as at 31st December 2014. So we have the revenue, loan interest paid, we have the purchases, we have the distribution cost, we have the administrative expenses, we have the interim dividends paid, we have inventory as at 1st January 2014. The method is the opening because our statement here, the trial balance, this trial balance is as at 31st December 2014, as at 31st December 2014. So which means that this inventory is as at 1st January. So that is an opening inventory, opening stock. Then we have trade receivables and trade payables, cash and cash equivalent, ordinary shares. We have the share premium. We have the general reserve, the retained earnings as at 1st January 2014, 4% loan payable 2024, which means that it's a long-term loan. It will be payable after some 10 years. So remember that is a long-term loan. A loan which is payable after 12 months. That is a long-term. The land and building, you have the cost, whereby land, the cost is 60 million. Accumulated depreciation you are provided with, plant and equipment, cost and accumulated depreciation. Investment property, you can see the figures. Rental income, the same. Proceeds from sale of equipment. Then additional information you are told, closing inventory amounted to 388 million at cost. However, shortly after the year end, some inventory with a cost of 15 million was sold for 8 million. Was sold for 8 million. Land and buildings, so which means that the main thing which you would be checking under this inventory. So the main thing you would be checking under this inventory, like now the first one, before I move to additional information number 2. The main thing I would check, remember that I said inventory we measure using which standard? Maybe someone can remind me. Which standard do we use to measure inventory?
IS2.
Which says?
Law of cost or net realizable value.
Congratulations for remembering that. So inventory is mentioned at the lower of cost and the net realizable value, which means that when you have your cost, then you check for net realizable value. So between the two, the lower. So you check the cost and the net realizable value. So the lower of the two is what now will qualify to be the inventory. So that is what I will do in additional information number 1. Then additional information number 2, land and buildings were revalued on 1st January 2014 to 800 million. In including land, 800, that is 100, not 800. 800 was the total. They have said in including land at 100 million. So the buildings have a remaining useful life of 40 years. The building have a remaining useful life of 40 years. So number 3, the income tax liability. So before I move to number 3, number 2, this one is concerning revaluation. So we have to check if there's a revaluation gain or loss on land and building. So what I will be computing in note 2 is all about to determine revaluation gain or loss. Number 3, the income tax liability in the year was estimated at 20 million. Deferred tax was to be provided at 7 million. So students, we always say that income tax, you are supposed to determine it by taking the current tax plus or minus, that is increase or decrease in deferred tax. You add tax under provision, you minus tax over provision. So that one will be done. We will do that, never worry. These just are mentioning what we will be doing in each additional information. Like now under additional information number 3, what I will be doing is just to determine tax which is payable in that period. Number 4, during the year, a company sold equipment which had cost 15 million with accumulated depreciation as at 1st January 2014 of shillings 3 million. So an item of plant was also estimated to be impaired by 4 million during the year. So during the year, the company sold some equipment which had cost shillings 15 million with accumulated depreciation as at 1st January 2014 of shillings 3 million. So an item of a plant was also estimated to be impaired by shillings 4 million during the year. So what we will be doing here, remember that you are told that there was some equipment which was sold. So when an asset is sold, we have to check, did the organization got a gain or a loss? Was there a gain or a loss? Then after that, there's depreciation note 5 of building over the useful life, then plant and equipment using reducing balance method. Then after that, they were saying that the company's accounting policy is to charge a full year's depreciation in the year of an asset purchase and none in the year of disposal. There's no problem on that. So the company treats depreciation of plant and equipment as a cost of sale and on land and building as an administrative expense. So we have to classify, remember, expenses according to the functional heads. We have to do that. You know that we have to classify expenses according to the cost of sales. Some expenses will go to the cost of sales. Some will go to the administrative cost. Some will go to the distribution. Some will be classified under finance cost. So that is why they were coming more specific. They were coming out and mentioning that. They were mentioning that once you do depreciation for plant and equipment, you are supposed to classify that under the cost of sales. And the depreciation for building, the examiner was trying to twist this additional information by checking if you know that rand is not depreciated. So he just mentioned intentionally that rand and the depreciation of rand and building as is to be taken to admin. So the depreciation which will be taken to the admin is for building. It's not for rand. It's only that they were just recorded together and they went ahead just to mention that. So the only depreciation which we determine and recognize under admin is the depreciation for building. Then after that, note 6, DORA limited values investment property at fair value. So DORA limited values investment property at fair value. So the fair value of investment property as at 31st December 2014 was 586. So if you can check in your trial balance, so the investment property, this one that are addressed here, in your trial balance, where my cursor is, the investment property is 548. So the figure for investment properties there 548. So which means that it increased to 586. So when a non-current intangible asset increases in value, that figure is an income. But if it was a tangible, like now land and the building, when they increases in value, that one cannot be just other incomes, but it will be other comprehensive incomes. I can repeat. When an intangible asset increases in value, like now investment property is an intangible asset. When it increases in value, that one is classified as just a normal income. That is other income. But now if it's a tangible, that is if it's a tangible, like now land and building, if it's the tangible fixed asset which increases in value, like now land and building, that one would be considered as other comprehensive income. And that comes in after you have considered tax and all other items. But remember that your normal incomes, the other incomes comes before you charge tax. Then finally, we have during the year, the company made a bonus, that is note 7. During the year, the company made a bonus. So that bonus was in terms of what? So during the year, the company made 1 for 3 bonus issue, capitalizing its general reserve. What is a bonus? What's a bonus issue? Dennis, what's a bonus issue? I know these are some of the things you have done already. In financial accounting, maybe if you have done financial statement analysis somewhere, you have done that. What's a bonus issue? How can you talk about a bonus issue? How can you explain about it? Someone can assist Dennis. Let's say anybody can explain that. What's a bonus? So when we talk about a bonus issue, this one concerns when an entity, like now this company was issuing shares to the existing shareholders on a certain proportion for free. That is at no consideration. At no consideration. So like now, yeah, the proportion was 1 for 3 bonus issue, capitalizing its general reserve. What they meant here is that this money which was financing the bonus was coming from the general reserve. The kizungu mingi, capitalizing its general reserve. The amount which was financing the bonus was coming from the general reserve. So which means that the bonus, remember the bonus, I have said that it's whereby the entity issues shares to the existing shareholders on a certain proportion at no consideration. We have other things like right issue, share split, reverse split. That one would be captured when you would be coming to advanced financial reporting under earnings per share. So then they say these transactions has not been accounted for. So it has not been accounted for. We will account. That is our work. That is why now you are examined. You have to account for that. you have to account for that amount. Then what you are required to do is the income statement, statement of changes in equity, and the statement of financial position. So far, so good. What we can do now is the computations. If there is no question so far, let us now go to the whiteboard and do the questions. Let us go to the whiteboard. And that is our whiteboard. I think you are used to that. So starting the question, we have to start from the additional information number 1. So whereby they were talking about the inventory. So the closing inventory, we were told that it amounted to 388. That is the cost. However, shortly after the year end, some inventory, which cost shillings 15 million, was sold for 8 million. So I said that inventory is mentioned at lower of cost and net realizable value. That is under the International Accounting Standards 2. And that is what we have to do here in order to determine our correct closing inventory. So the cost, already you can see the cost is 388. That one is provided, the 388. That is given. Then after the 388, what we have to determine is now the net realizable value. So the examiner said that shortly after the year end, some inventory which cost 15. Some inventory which cost 15 was sold at. They were sold at what?
8.
They were sold at 8. So which means that they made a loss of 7. Remember that these goods which were being sold were part of this. The 15, they were sold at 8. So which means that we made a loss of 7. And that one implies that our cost of 388 will be reduced by that loss of 7 to get a net realizable value of 381. To get a net realizable value of 381. So the low of the two is what? 381. And that one will be our closing inventory. That one will be our closing inventory. Additional information number 2, land and buildings were revalued on 1st January 2014 to shillings 800 million, including land at 100 million. So the buildings have a remaining useful life of 40 years. What we are supposed to do here is to determine revaluation gain or loss. So the revaluation gain or loss, revaluation gain stroke loss. So the revaluation gain stroke loss. So this one is concerning, remember, it's land and building. Land and building. So we have to start with the revalued amount. The revalued amount. So the revalued amount, we were told that it was 800, including land 100, which means that this is 100, this is 700. So we have to compare with the net book value. What we do, we have to compare with the net book value. The net book value of the same assets, the land and building. So we can be able to conclude that if there was a revaluation gain or loss, of which you know that net book value is the cost minus accumulated depreciation. But for land, it's obviously stated at cost. Land is obviously stated at cost. So we have to check the net book value of those assets. So the net book value of these assets is, so you can see land and building, you are given here land and building, whereby the cost, you have the land is 60. which I said obvious land is stated at cost. So the total value was 380. So the one for building is 380 minus 60 is 320. So this one will be 60. So that the net book value for building will be the cost minus the accumulated depreciation. Because now building must be depreciated to get the net book value. You have to deduct the accumulated depreciation, but the land, there is no way you can subtract depreciation. So which means that here you have land and building. So this accumulated depreciation, which was just next to land, the 64. This one was for building, the 64. We have to subtract the 64. So 320 minus 64. I think you have the calculators, guys.
256.
That is 256.
6.
So which means that you can see this was the initial figures of these assets. So after evaluation, this one was revalued upwards by 40. Then the other one, it was revalued to 700. So the difference is a revaluation gain of 'So the second one, the figure you are getting there, a revaluation gain of
444.
So that is 444. So the total revaluation
484.
total revaluation is 484.
84.
Then there's something they mentioned. They said that after evaluation, what happened?
The buildings
Are you
building 40 years.
What are you supposed to do when you are given useful life? Huh?
We divide by 40
To determine
revaluation.
To determine
Determine
To
depreciation.
and which method is that?
Straight line.
Yes, that is straight line. So we have to divide with those years so that we determine depreciation. So, and that is the straight line method. So which means that I will take after evaluation, remember that it was 700, this one for the building. It was having a useful life for 40 years. So 700 divided by 40. So the depreciation there is
17.5.
So that is 17.5.
5.
So that is good. And that is an expense. We have to classify it later. Maybe as we were told, I think it was to maybe admin. So we will check on that, where it's supposed to be classified. So let's move to note 3. They said that the income tax in the year was estimated to be 20. Deferred tax was to be provided at 7. Deferred tax was provided at 7. So when you see a statement of that kind concerning those tax, what comes into your mind, you can even write a formula, even if there's no computations on that, but I have to tell you something, what you are supposed to do. So because in some illustrations, in some questions, you might find other items other than what has been provided there. So when you are determining income tax, you have to check your current tax. This current tax is just the corporation tax in the current year. Then you say add or minus the increase or a decrease in deferred tax. in deferred tax. So remember that the deferred tax is all about provision for future taxes. Provision for future taxes. The taxes of the future, you provide it now. So if there was a provision you made, so the increase or decrease, then we have tax, we add tax under provision. So last year you were supposed to pay a certain tax, but you under provided. So you have to pay it in this year. So tax under provision. Then we have to minus tax. You have to minus tax over provision. So in the previous year, you overpaid. You overpaid. So it will reduce your tax for the current year. But in this question, there was just 20 plus 7. Yes. There was this aspect of current tax and the provision they made. Just a provision they made for deferred tax of 7. So, and I will request that only mute when you are speaking. So if you have something to talk about, just you are allowed to unmute, but try to maintain your background. So after that, additional information number 4. During the year, the company sold some equipment which at the cost shillings 15 million with accumulated depreciation as at 1st January 2014 of shillings 3 million. An item of plant was also estimated to be impaired by 4 million during the year. So during the year, there was an equipment which was sold, which was having a cost of 15, accumulated depreciation of 3 million. So what we are supposed to do, we have to do a disposal account to determine when this disposal of equipment took place. Was there a gain or was there a loss? So the next thing you have to do is the disposal account. And this one will concern the equipment which was, it will concern the equipment which was sold. So remember this cost, you have to be, you credit accumulated depreciation, then sales proceed. That is how you prepare the disposal account. This is the standard way. Cost, accumulated depreciation, sales proceeds of that asset which was sold, the equipment. So the three items you consider is for the item which was sold. So it was having a cost of. So right now, that is the point where you are supposed to tell me, you unmute and say the cost was. So during the year, the company sold some equipment.
15.
So that one was 15 and accumulated depreciation was 3. The accumulated depreciation was 3. So 15 and a 3. What about the sales proceeds? The sales proceeds was because in this statement, they say during the year, the company sold some equipment which had cost 15 million with accumulated depreciation as at 1st January 2014 of 3 million. An item of plant was also estimated to be impaired by 4 million during the year. So what was the sales proceeds? So if you come here under your trial balance, so it's not a must they provided there. They gave us under the trial balance. Proceeds is the last item in the trial balance. Proceeds from sale of equipment, 7. This 7. So the balancing figure will be on this side, because this is 15 and this is so this is for it to be 15, we must have a balancing figure of 5, and that is a loss. So if it's in this side, this one will be again. So if the balancing figure is on the debit side, If the balancing figure is on the debit side, that is again. If it's on the credit side, it's a loss. We are done with that. So we go to the next additional information. Sorry for that. We go to the next additional information. So this one. So the additional information here. So they say that depreciation. So remember this sentence I have ignored. That one will be captured later. This under additional information number 4, there are sentence. They say that an item of plant was also estimated to be impaired by 4. That one I will come to record it later. This is like now an expense. This is an expense anyway. It's not like an expense, it's an expense. Number 5, depreciation rate as per the company's policy are as follows. So building over the useful life. So that one we are done with it. Remember that after evaluation, note 2, the building was having a remaining useful life of 40 years. We took 700, we divided with 40 years. We got 17.5. That is what they were mentioning here. Building over the useful life. That one, we are done with that. Note 5 again, under that, after building, we have a plant and equipment, 20% reducing balance. 20% reducing balance method. So we have to do that, plant and equipment. But what you need to know is that there's a plant which was disposed. Never forget that. There was an equipment, not plant. There was an equipment which was disposed. So on this one, they need what? Plant and equipment, the depreciation using reducing balance method. So the depreciation on plant and equipment so I was saying that before even you do this depreciation, remember that there was an equipment which was disposed. So what you do, first you have to get the correct cost and the correct accumulated depreciation before disposal. That is not before disposal, but after disposal. Because you know that depreciation using a reducing balance method, what you do is cost minus accumulated depreciation of that asset. You multiply with the depreciation rate for the year. That is how the method goes. Cost minus accumulated depreciation. After getting that relevant figure, you multiply now with the depreciation which you are provided to get the depreciation for the year. But now, before we do that, remember that there was an equipment which was sold. And the figure we have in the trial balance represents all of the equipment in the organization. That is why I am saying that before we apply the formula of reducing, we have to get the correct cost and the correct accumulated depreciation. That is after disposal of the equipment. So after the disposal of the equipment. So on that one, remember that the plant and equipment in the trial balance here, where my cursor is, plant and equipment, cost was 258, accumulated depreciation was 126. So 258, 126. So we have to subtract the one which was disposed. The one which was disposed was having a cost of 15, accumulated depreciation of 3. so that we get a correct cost of 258 minus 15. This is 243, and this is 123. So after getting this cost and accumulated depreciation, now we can apply our formula by taking this cost minus accumulated depreciation. We get 120. So getting 120 from there, we can say that our depreciation now is, depreciation now for the year will be the depreciation rate of 20%. You multiply now with the 120, and this one gives us 24. That is what we are looking for. After that, the other information is just they are told, they have said on how we classify those depreciations. Note 6, dollar limited values investment property at fair value. The investment property, that is the fair value of investment property, was 586. I said that when intangible assets, they increase in value, so that one is just a normal income, other incomes. But if it was tangible, like now land and building, that one is revaluation. We have done that. We did that for the land and building. But now this one, since it's an intangible, when it increases in value, that one we call it other incomes. It will be recorded just a normal income before even tax is charged. So which means that it increased from 548 because the investment property in this trial balance is 548. It was increased to 586. So 586 minus 548, that is 38. That is 38. So 38 is a normal income. So increase in fair value of investment property. Then finally, you are told that during the year, the company made 143 bonus issue, capitalizing its general reserve. Capitalizing its general reserve. These transactions has not been accounted for. This transaction has not been accounted for. So we have to account. So we have to determine the bonus. So it was the company made a 143 bonus. That one means for every 3 shares the shareholders were having, they were given 1 share as a bonus at no consideration, at no price, for free. So we have to determine how many shares the company issued in terms of bonus. In terms of bonus. So we say 3 for everyone. How many shares the company had issued to raise a certain capital in that question? How many shares the company had issued?
100.
100. 100 is the total value. So the shares is 10. Because you can see,
14.
yes, because the ordinary share capital, shillings 10 each. So in order for them to make this capital of 100, the shares which they had issued is 10 million. So we go with 10 because our question is in terms of millions. So we say 10, but it's 10 million. So those are the general shares which the shareholders were having. Because for the entity to raise 100 million, they had issued 10 million shares. So they came and made a bonus. So that is what I would equate. For every 3 shares, the shareholders were having, they were given 1. But remember that the general shares, they were in possession with this 10. So what about that? So 10 times 1/3. So how many shares did they issue in terms of bonus? 3.3 shares. 3.3 shares. So that now to get the total value to record in our statement of changes in equity, remember that we have to get the value. You multiply with the 10 per share. We get 33. You get 33. So after that, we are done with the match are working. So what I will do is only the statement of expense allocation.
300.
Statement of expense allocation. 300, which is the 300, my good student? Which 300 are you speaking about? I can correct you. It's 33. It's 300 or 33. So we continue now to the statement of expense allocation. So the statement of expense allocation, this whereby we have to classify expenses according to their functional end. Like now, the cost of sales. Some expenses will go to the cost of sales. Some will go to the admin. Admin, I mean administrative. It's only I've written in short. Then we have distribution. So remember that we have to start with the balance brought down, which is as per the trial balance. Which I know that if you are not given the cost of sales, you determine. You take the opening stock plus purchases minus the closing stock. Opening stock plus purchases minus the closing stock. After getting that, we classify some expenses under that. So cost of sales was not there, so we determine opening stock is this inventory, 444. So you take 444 plus purchases is 1669. So plus 1669. And remember that our closing stock was 381. Now our working number one. From our working number one, we got 381. So which means that my cost of sales will be 1732. Opening stock plus purchases minus closing. For the admin is 345, this one. Distribution is 514. Then after you are done with that, you come now to additional information. You start from additional information number one again. You check if there's any expenses. Now, in your mind, you know what you did in the interpretations you are doing. Remember, note one, what we were doing is just to determine closing stocks. There's no expense on that. What about working two? There was this building which was having a useful life of 40 years. We got the depreciation on building. And remember that you are told in this additional information number 5 here, this last sentence where my cursor is, the company treats depreciation of plant and equipment as cost of sales and land and building as administrative expense. So which means that our 17.5 will be classified under this, because this one concerns depreciation on building. Concerns depreciation on building. So that was additional information number 2. That was the only expense which was there. Additional information number 3 was concerning tax. Tax would be dealt with later. It's okay.
The land and building is administrative, not cost of sales. Plant and equipment is the one cost of sales.
Oh, that is good. As they mentioned,
Yes.
Yes, that is fine. It's only that we have done just a short mistake. So they said that we classified it under admin. That is good. They were very specific. Good. That is good for that correction. Number 3, I have said, is concerning tax. So tax will be dealt with later. You pay tax after you have profit before tax. After you get the profit, your profit, you pay tax. Number 4, remember we did a disposal account. We got a loss or again? We got a loss of 5.
A loss of 5, yes.
Where can we classify that? Where can this be classified?
Selling and distribution expense.
Classify under cost of sales. A loss is a cost you incurred when you are doing a disposal. Under cost of sales. It's a cost you incurred when you are disposing assets. Sometimes they are lenient on you. Even if you put in distribution, the examiner can mark it for you when you come to present it, because obvious the totals you will get from the 3, if you sum up together, whichever you classify, whenever the method used of classification, that total will be the same. The total of the 3 will be the same. Sometimes, yes, I know some students mess when they classify this on this side, on the other side. They are lenient when marking concerning the classification. They cannot penalize you. Then there was another expense under note 4, an impairment. An item of plant was also estimated to be impaired by 4. So that one I would just write impairment. Then note 5, remember this was for plant, impairment of plant. Then again, note 5, there is a depreciation of the plant, depreciation of plant. And this one, they mentioned that we record under cost of sales. So which means that even this will be under cost of sales because it was concerning plant. So that one can guide you such way. Because obviously you know that impairment is again the loss in value of that asset. The same with depreciation. Is there another expense I have not classified? I think we are done with that. So you always start with the balances brought down as per the trial balance, come to the additional information, check the expenses which are there, classify, go back to your trial balance again, try to figure out if there's another expense which you have not classified. For the trial balance, there was none. In some questions, you would find that there are some, but in this question, there is none. So if there's a sum of the expenses we have not classified under cost of sales, admin, and selling and distribution, you again do your classification using your knowledge, your accounting knowledge from the understanding of cost of sales, administrative cost, and the selling and distribution. So what you are supposed to do, give me the totals of the 3. So I can assist you on the last one, even the second one.
The first one is 1765.
1765.
Yeah.
So once you are done with this work of workings and classifications, I always say that the question is over because the other work is just a work of copy and pasting, the presentation of the statements, and that is what is marked. These workings are not marked. So what we have been doing, as a student, you are supposed to do it in the shortest time possible. A question is supposed to be done within 36 minutes in an exam scenario. So let us now present an income statement. So this was a question of Dora Limited. It was a question of Dora Limited. So income statement. So we have for the year. So it was for the year ended when? Our question was for the year ending 31st December 2014. Because I can see the trial balance is as at 31st December 2014. So what you do, you start from revenue. So revenue, you pick just from the question. Revenue is Rostodon. What is the revenue?
2648.
So that is 2648. I think for the others, it's the same. For the other students, I mean, is that the same? So this just picking direct from your trial balance. It's not something you have to, sometimes they call it sale. So sometimes they can call it turnover. So never go to exam looking for revenue. It's not there. You say that it's not there. They call it sales. It's turnover. So rest cost of sales. Cost of sales is what we have done from our last working. The statement of expense allocation. So we got 16. That is 1765. We got the 1765 there. So you subtract, you get a gross profit.
883.
A gross profit of 883. Then you add some incomes. Which are some of the incomes we add there? We have some direct from the question and some which you need to do like a small working. So there's this, the second last item here, rental income of 48. And again, there's this investment property, which I said, it increased in value from 548. And you were told in the additional information number 6 that the fair value of the investment property as at 31st December 2014 was 586. So we get the difference of 38. So we have those two, rental income of 48 and increase in fair value of investment property. Increase in value of investment property. So this one was 38. So those were the only two. The rest expenses. So the expenses is all about the administrative. Administrative expenses, 362.5. This one from our last additional information. And we have distribution. So the distribution cost, that is 514. Then after that, you get profit before interest and tax. Profit before interest and tax. So interest is finance cost.
Excuse me, Marlene.
Yes.
Sorry.
Yes, it's okay.
You said that there is a impairment loss and it's an expense.
It has
Are
been,
we supposed to include it here before we go?
You can see there.
Oh, okay.
So what you need to know is that,
I see. Thank you.
again, what I need to correct in your mind is that According to International Accounting Standards 1, when you are classifying now your expenses goes to admin, expenses goes to the distribution, some expenses goes to the cost of sales, and some goes to the finance cost. Never come to your statement and start showing expenses here. That is why I did this. So once you come here and you start showing me that there's impairment, there's salaries, there's depreciation, I will just cancel your question this way, because you have not followed the standard IS1. So which means that you don't understand the topic. I cannot, an examiner cannot mark such a question, because he expects at least write the format and write what you know according to the format, but never start showing those expenses individually. And that is what I started even explaining when I started the topic. I said that expenses are presented on functional basis. And that is what we have done here. So those all expenses, we have classified them on functional basis. So finance cost is another one. It will be containing interest related expenses whereby they issued loans. So there was only one loan which was issued, 4% loan. So you take 4% on the loan, 4% of 150 is. So you take 4% of the 150. That is how you get that is the interest out of that loan. The 6.
Yes.
6.
Yes. What is the answer here? Profit before interest on tax.
92.5.
So that is 92.5. So up to that point, we have profit before tax, which is
86.5.
86.5. Then we raise tax. We raise the income tax. So remember that our income tax was 27. We did from the working 20 for current and 7 for deferred. It's under additional information, 20 plus 7. I think it's additional information number 3, but that one we talked about it earlier now. So up to that point, we have the profit after tax. Profit after tax of
59.5.
59.5. Then add other comprehensive income. Add other comprehensive income. So other comprehensive income is concerning revaluation gain or loss on land and building. The revaluation gain stroke loss. So there was again, we got which figure? We got a revaluation of 400 and it is there.
408.
Yes, 484.
Yeah, 40.
So 484. So add with the 59.5 so that you give me the total comprehensive income.
543.5.
543.5. That is good. That is good. So the next requirement was statement of changes in equity. So Dora Limited statement of changes in equity. So the statement of change in equity, that is for the year. So that one was for the year ended 31st December 2014. So you go and check the equity components we have so that we list, then determine now their changes. You check the equity components which we have. Remember that I said the statement of changes in equity shows the changes in equity items, like ordinary share capital, share premium, revaluation reserve, retained earnings, general reserve. So according to the question, under the statement of changes in equity, we can see that we have ordinary share capital, share premium, general reserve, retained earnings, and revaluation reserve. And that is generally what can be there in any statement of changes in equity. Those are some of the maximum equity components which can be present. So ordinary share capital. So I will write in abbreviation so that my space can be enough. We have share premium. So ordinary share capital, share premium. And then we have general reserve. Then we have the retained earnings. These are just picked direct from the trial balance. Then the last one, which is not there in the trial balance, is the revaluation. You remember the revaluation of land and building. The revaluation of land and building. The revaluation reserve. So that one is under additional information. Then there you write total. Then what you do, you just copy the balance brought down from the trial balance. Balance brought down. So the balance brought down is?
100.
Yes, that is 100. The next one is?
244.
Yes.
349.
That is for general reserve or retained earnings?
Retained earnings.
General reserve?
570.
So that is 570. Then this is a dash. It's not there in the trial balance. The revaluation reserve is not there in the trial balance, but we have a revaluation reserve for land and building. That one will be recorded later, but it's not there in the trial balance. That is why I'm getting dash. So the total? So my calculator is giving me 1263.
Yes.
So I want to just record the entire format the way it is. Issue of shares. Was there issue of shares? Sometimes it can be at premium. There was no issue of shares. So that one could have affected those two and the total. So the only thing which was there is a bonus. So this one, remember, it's the shares which they issued for free. And that one was capitalizing its general reserve. So which means that we got 33. The 33, which you can see there. So they said capitalizing its general reserve. So which means that the amount of 33, which was financing this, was coming from general reserve. So we subtract there, we add here. We are adding there because obviously their capital increased. Even if they never realized anything, we have to just recognize. So this is supposed to be dash, this is dash, this is dash, because there's nothing there. This is 0. The next, we have to recognize if there's a revaluation gain, of which there was a revaluation gain of land and building. So it goes to the revaluation reserve. I remember very well, it was 484. So after that, you have to come and record profit for the year. Profit for the for the year. So the profit for the year was remember that the profit for the year is what you have done here. Profit after tax.
59.5.
59.5. This one.
5.
So 59.5. That one goes to the column of retained earnings. 59.5. And a total of 59.5. Then after that, you have to subtract dividends paid. Dividends paid. So there was a dividends paid of. Remember, the dividends paid is out of profit, so it goes to the retained earnings. You have to pay it out of the retained earnings, the dividend. So you can see interim dividends paid of 6. Interim dividends paid 6. And it goes to the total. Then after that, maybe if there was some transfer to reserve, we could have recorded, but there's none. Transfer to general reserve. This one could have been recorded. So what we could have done for the transfer to general reserve, remember that you subtract some amount of transfer, the amount which was supposed to be transferred, you deduct it from the retained earnings, you add it to the general reserve. So that this one is 0. Give me the totals. This is 133. This is 244. This is 484. So what about the 2? 570 minus 33. 537. Give me the quorum of retained earnings. 349 plus 59.5 minus 6. 402.5.
Or 2.5.
So for the total, so this is 1800.5. 1800.5. That is what I'm getting here, according to my FX82 MS.
Yes, correct.
So after we are done with that, remember that we have now to do the last part of the question, statement of financial position. But in mind, what are you supposed to do? Which working?
PPE account.
Yes, you have to do the PPE so that you determine your one figure for the tangible and current assets. So let us do that, then present that statement so that we can call it a lesson for today. I know some of you are going to watch the final of Euro, or you are not footballers. You are not fans. So what we have to do is the first concerning the PPE, the property, plant and equipment. So remember that we have various assets, like now land and building, but the land was revalued. Land was revalued to what? Building was revalued to which figure? So those are some of the assets we have. We have plant and equipment. So land was revalued. So you record the revalued amount because here initially it was 60 as given in this trial balance. Land and building 380, but 60 is for land. So if you go to additional information 2, they say that land and buildings were revalued on 1st January 2014 to 800 million, including land at 100 million. So the buildings have a remaining useful life of 40 years. It's okay. So land, it's 100. Building, it was 700. It was revalued to 700 because now the total is 800. For land is 100. So the difference is 700. But I cannot record 700 for building because there was a depreciation of 17.5. So that is whereby we took 700 after evaluation, you divide with the 40 years. You get the depreciation for that 1 year. So which means that this one we record 100. Then this one we record 700 minus 17.5. 700 minus 17.5 is
682.5.
682.5. Then another asset which was present,
Land.
there was this plant and equipment. Plant and equipment. So this was the only challenging one. This was a bit challenging, but I can be able to put it across so that you will understand why it was a bit challenging. So what you will do, remember that we did this. When we were determining the depreciation, first remember I said we have to deduct the one which was disposed so that we get the correct cost and the correct accumulated depreciation. Then after that is when we determine the depreciation for the year of 24. So in order to get the NBV, net book value, remember that we have to take the 343, the correct cost after disposal, minus accumulated depreciation of 123, which we got 120, minus depreciation for the year of 24. Remember it was reducing, that is why I'm minusing accumulated and depreciation for the year. Then what am I supposed to minus again? There was that aspect of 4, which they were very specific. It was concerning impairment. So if they could have ignored to say there was none of the impairment, what we could have done is just minusing accumulated and depreciation for the year. This one, they were very specific. That is why we subtracted 4. It was an impairment of plant. So our net book value will be, so if you take 243 minus 1, minus that is, the answer is
92.
92. So that is what I would be
192.
192. Are you sure?
243 minus 123 minus 24 minus 4. Oh, 92, sorry.
So I always calculate. So that is fine. So that is 92. There was no another cent. Give me the total. So that is 874.5. That is according to my calculator. So that we say Dora remitted a statement of financial position. Statement of financial position. Assets. So the statement of financial position asset, our financial year was ending when?
31st December 2014.
So non-current assets. So property, plant, and equipment. So the property, plant, and equipment. 874.5. So you are not supposed to show the tangible long-term assets here. So what is supposed to be shown here is just property, plant, and equipment. That is according to International Accounting Standards 1, and that is the rules you follow. The intangibles, you can show them. Like now there was investment property. The one which was revalued, according to note 6, you can check on that. It increased to what? 500 and I remember it was in the trial balance, it was 548. But in note 6, they said it was revalued to 586. Remember that when it was revalued, you record the second amount after revaluation, that is. So we move to the current assets. You start with inventory. Inventory is the closing. We did working one, where I said we weigh this using IS1, IS2, IS what? IS2, not 1. IS2. So we got 381. This was the lower between the cost and net realizable value. The lower between the cost and net realizable value. You check your debtors, trade receivables, debtors. This is an asset. You know these components of current assets, I think you know. Debtors was the trade receivable balance was
55.
this
545.
This was 545. Then I can see again this cash and cash equivalent there of 28. So 545. Then cash and cash equivalent. Cash and cash equivalent of 28. So up to that point, remember we have total assets. There's nothing concerning assets. There's no prepayment. You know, a prepaid expense is a current asset, but it was not there. There's no bank balance. So what we have recorded is what we have. So then we have equity and liabilities. Equity and liabilities. So which you know that for the equity, you copy from your statement of changes in equity. The balance is carried out. You just do a copy paste. So this was our statement of changes in equity. So ordinary share capital. So ordinary share capital is 133. We have share premium. Share premium is 244. General reserve. So general reserve is the general reserve is 537. So I'm copying from my statement of changes in equity. Retained earnings. Retained earnings, the balance down there is for 2.5. Then revaluation reserve. The revaluation reserve is 484. So up to that point, we call it this one shareholders fund. We call it shareholders fund. So shareholders fund is 1800.5. Then non-current liabilities. So non-current liabilities, we have some of them. So which are the non-current liabilities we have? There was that
Loan.
the loan, which they said payable 2024, which means that it was wrong term. That is why they said payable 2024. Remember, any liability, any obligation set in a period exceeding 12 months, that is a wrong term obligation. So 4% loan. It was 150. Never forget deferred tax. Additional information number 2. Deferred tax is the provision for future taxes, the future tax obligations, the provision of 7. Then let us finish with the current liabilities. So the current liabilities, trade payables, this one is from the trial balance direct. You just copy from the trial balance. You can check, it's 434. Then we have 2 things which are remaining. So current tax obviously is a current liability. They always say that it's estimated is to be provided. That is what they always say. Current tax is estimated or is to be provided. That is according to note 3. The income tax in the year was estimated. You can see that. Sometimes they say is to be provided. So that is a current liability. Then the last current liability is accrued interest. So what you can see here, the interest on the 4% loan, we got which figure? Interest on the 4%. 6. But you can see they say our second item here, the loan interest paid is 3. So the total interest on this loan was 6, but already 3 has been paid. So the balance of 3 is accrued. So for current tax is 20, then accrued interest is that 6 minus the 3 which has been paid, which we get the 3. So try to balance the equation. Total equity and liabilities. Total equity and liabilities. What are we getting there? For assets, total assets is total assets, both
14.5.
20,
2014.5.
20,
2414.5.
2414.5. What about the equities and liabilities? So you can start even 1800.5 plus 150 plus 7 plus 424 plus 23.
The same.
It's the same. So 2414.5. And that marks the end of the question.